Today we got to go different theme, man. We're gonna go theme, man.
Cool. I may jet out in between. It's my wife's birthday, but let's go
All
on.
right. We need some serious. This is a serious theme here, man. We gotta
Yeah.
get started in a couple minutes here. All right, it's time to get going here. It's time to get going with the live, man.
What's up? What's up, man?
What's up, man? You came right in time. I'm about to go trying to get this thing kicked off here.
Yeah, I'm in a
lose here.
car somewhere off.
All right, let's do it. Let's do it.
But
All right, guys, welcome back to our welcome back to our Facebook group live. This is January 31st, 2023. And today we're going to be talking about, listen, this is a terrible time to invest right now. This is probably the worst time in history to invest right now. Inflation is sticky. I mean, people, interest rates keep going up. And the economy is starting to slow down, but inflation is not slowing down. We have a war in Russia that we continue to spend billions of dollars and print money and send to. This is an uncertain environment, right? Now, potentially, China is going to invade Taiwan, which would also include American military involvement. And again, we're looking at more uncertainty. So, is this really a good time to invest, or is this a time that we should fall back? That's what we're going to be talking about here today. My name is Dr. Jonny Walker, or Dr. Jonathan Withanachchi. I'm an endodontist by trade, and of course, a real estate investor. I've been heavy in multifamily real estate investing, and we've invested in over 870 apartment units over the last 4 years. I'm joined alongside my esteemed co-host here, Tom, 10X Tom, as well as NL. That's Noel Liu. But maybe he'll join us in a little bit. So, Tom, why don't you introduce yourself a little and tell us a little bit about yourself and how you got involved in real estate investing, and then let's get right into this.
Yeah, absolutely, man. So excited today. I know there's a lot going on, but today's topic, I'm so excited that we're going to cover the state of multifamily investing. I'm so excited to talk about that with my co-host, Dr. Jonny Walker and Dr. Noel Liu. I'm not a dentist. I'm a serial entrepreneur. I own a digital marketing agency. I own a couple other businesses, and I started investing about 2.5, 3 years ago. Started with the 6 unit, and I quickly realized that, man, I got to scale up. Otherwise, it's not going to work out. It's going to be a second job. And then I joined some mastermind, got educated. Now I'm invested as a GP in over 1,000 units, and as an LP is around 1,600 units as of last week when I checked the numbers. So excited to share with you. Our goal is to educate you, help you get invested in real estate and generate some passive income so you can have financial freedom. There you go.
All right, sounds good. Sounds good. So, so now we're talking about this about investing in today's market, right? I mean, is that time to invest? I mean, is this a time that we should maybe fall back a little bit and wait to see what happens, or do we keep going, or do we switch to invest in something else, like maybe short-term rentals or something? I mean, what should we invest in right now? Should we stay in the stock market and hope for the best? I mean, I don't know. What do you think? What do you think about investing right now? I mean,
you're asking some great questions. Like, yeah, you're asking some great questions, man. I mean, like, everybody is worried. Everybody is holding on to their cash, right? And everybody's like, man, I'm just going to wait for a little bit and then invest. So here's the thing with investing, though. What I've learned is that, when everybody is afraid, right? What did Warren Buffett say? When everybody is greedy, be afraid.
Be
When
fearful.
everybody
Yeah.
is afraid, make your move. That's the bottom line. So there is going to be a lot of deals that's going to be coming up in the market. It's already starting to pop up. And
Yeah.
you should be ready to pounce on those deals. But here's the key though. If we keep just waiting for that deal to come up, you may never end up investing. When we invest, like Johnny, myself, Noel, when we invest in deals, it doesn't matter if the market is high or low. We always go by the data, the numbers. The data is your friend. If the deal is not going to make sense, we are not going to invest. It doesn't matter if it's an up market, low market, middle market. Every time, all the time, as long as you invest based on the numbers, based on the data never lies. You will always be fine, especially in
Yeah.
real estate. Time will make sure you come out successful.
Yeah, I mean, I agree with that. I mean, people, you can't really time a market. I mean,
Yep.
when is the top of the market? When is the bottom? Nobody really knows. I mean, before COVID happened, everything was to the top, right? Real estate was
Yep.
peaking. Then all of a sudden it dropped. And then it came
Yeah.
back up again. And then it
Yep.
went down again, right? Like,
That's
so,
right. That's a funny thing, right? When COVID
but
happened, everybody thought it was going to go down.
yeah, but look, even when it's up, right? That means there's more competition. There's more
Yep.
money that drives up prices, right? So when there's less competition, there's less banks and stuff lending, but there's also less buyers. So there's less competition. So like Tom says, it has to pencil, right? So we have to make the deal work as well as looking forward at the risks and try to make as well of a risk-adjusted decision as you can. You know, I mean, to Tom's dislocation creates opportunities.
Mhm.
You know, I mean, this market there's going to be a lot of distress at some point, right? Because interest rates have gone up. Interest rates have gone way up at an unprecedented rate, at historic levels. America's never seen interest rates rise so fast, so quickly. Just
Yep.
this year, 2022. And what happened is people step back, like, oh, banks step back. Banks got scared, right? They stopped lending. They started increasing their equity requirements, decreasing loan proceeds, right? So now we have short floating rate debt. The old before 3-4 years ago, people got into it, maybe didn't have the foresight to see that the party is going to come to an end at some point, gets into bridge financing. And now all of a sudden the loan comes due 2023 and you're underwriting at a 3% interest rate. And now it's 7%. Your debt payment doubles. And now all of a sudden you can't cash flow, right? You can't. And then on top of that, the banks say, and you have to escrow more money each month to buy a rate cap, which squeezes cash flow even more. And the thing is, all this time in the last few years before 2022 crash, all these great operators, poor operators, and average operators all got into the place. And we were seeing real estate values, multifamily real estate values soaring.
Yep.
Even
Everybody
when
made money.
operationally they were poor. Everybody was making money. Even if you weren't running the property correctly, even if you weren't renovating units, rents rose 20%. And just as you were in a rising tide that raises all ships, you sell at a huge profits and you feel like even the bad operators are making money. But now here's where you're going to see the rubber hit the pavement, rubber hit the road. Now you're going to see when floating rate debt comes due. What's going to happen when these not great operators get squeezed for cash? Do they have the reserves? Do they have the network to go and speak to consultants and their own within their network that they can navigate through this mess? Do they have the staff? Do they have the systems? Right? So these are the things that are going to separate, and you'll see a lot of distress. And there's going to be challenges for owners, right? And then they're going to come to us and they're going to be like, wait, we can see that there's a lot of vacancies here. You know, you're not getting market rents because you haven't renovated any units. There's tons of upside here for us. All we have to do is it's only 85% occupied. If we renovate 10% of the units, this 300 units, say, That's 30 units that are getting zero income currently. We go in, quickly renovate them and rent it at market rents, and we already driving profits, right? And then just from occupancy and just from getting small rent increases. So now on top of that, these owners are like, hey, I got to unload this asset before the bank comes and takes it from us. What can you offer us? Right? People are under pressure to sell now. And that's where the opportunity lies, and that where a good operator will step in and make them a lot of money, right? So let's get into now. Okay, so now we can see that there's going to be distress in the market. There's already distress, and we can see that there's still potentially. So where should we invest right now? Where in the world should I put my money right now? I heard somebody say that this is an investor winter right now. We're in a winter. We went through the bad times, right? Are we at the beginning of the winter? Are we at the end of the winter? That is up for debate. Nobody knows. But how do we survive the winter as investors? Right? So let's talk about our options. The stock market, that used to be the only option that we ever had as doctors, right? Nobody really knew about investing in anything else. So it's like the stock market is down 25% right now. NASDAQ's down by 44%. Is that most analysts, everybody's going to agree that equities is going to go down further, right? Interest rates are still going to go up. Economy is still going to
Jonny, here.
slow down.
However, in the stock market, there's been a bounce now from the lows, but be very careful. Very careful with that. They call it a dead cat bounce. I mean, if people are now like, oh man, okay, it's back up, man. Tesla
It's coming back, but
be careful, guys.
It's a temporary spike.
Yeah,
correct. Agree. I mean, you got to look at it. Think about it at the fundamentals. The economy is going to get slower. Inflation's sticking around, and we're in a position that we have to keep printing money despite inflation. This is a dangerous time we're in. We're in this is not like any other recession. I mean, the greatest thing, like Ray Dalio, the big thinkers, the financial magnates that have known had track record of being able to see into the future. They see a lot of uncertainty here. We're not in a regular recession here. So now, all right, so if we can't go in the stock market, right? Equity is not coming back anytime soon, right? So then what? I mean, cryptocurrency. I think that train's already left the station.
That train's
and it
gone.
crashed and burned, right? I know a lot of guys lost money in crypto. I mean, I had a small percentage also. I keep, like I told you, I have 80% in cash flowing assets, and I have 20% that I'll do in more speculative investing, and I had about 5%. I mean, I still have Bitcoin, Ethereum, but where is it now compared to what it was? Right. So that's crap. When will it come? I mean, I still believe in Bitcoin a little bit, but anyways, that's another side note. And like, what does the wealthy people do? Right. Like guys like Warren Buffett, what does he do with his millions? I mean, billions. What is the greatest investor in history do? Right. He didn't fall prey to the .com bubble. People, Warren, you're so dumb. Look at the values. This guy's an old guy. He doesn't understand that internet, and he doesn't understand the wave of the future. And he missed this thing. And but Warren Buffett kept saying, it doesn't pencil. This doesn't pencil. I mean, how are you guys getting these valuations for these .com? And of course he was right. They crashed. And then what did he do during that .com bubble recession? He went in and bought tons and tons of undervalued businesses at pennies on the dollar and made a fortune. And ask yourself, like, why were those companies undervalued? Right? It was undervalued because of fear. Point blank range. There's fear in the marketplace. There's fear of what the economy is. There's fear about the war. There's fear I'm going to lose my job. Multifamily real estate, same thing. Multifamily real estate prices went highs in early 2022, right? Then just 3 months later, prices fell down. Bottom fell out.
Right.
Prices dropped by 15%. But ask yourself why? Why? Did the demand for housing drop? Nope. Did rents drop? Nope. What changed? The only thing changed is that there's fear. Right? Fear causes buyers to pull back, causes banks to pull back, and the banks to decrease proceeds, right? They decrease leverage, they decrease the amount of, the debt that they're going to offer. But fear, but why though? I mean, there's still a housing shortage. In fact, it's even worse today than it was just a few months ago, right? Rents are still increasing due to inflation.
Rents, right?
Especially what the
Yeah.
market conditions are in cities like in Houston. We've seen tremendous growth in Houston during a
So
recession.
here's
Right?
here's
Just
why the
let me
rents are
finish.
increasing.
Yeah.
Right. Here's
Talk
why
about
the
that.
rents
Talk
are
about that.
increasing. Right. Yeah. I mean, we got to keep in mind, interest rates are high. Less people are going to buy houses, and when it comes to buying houses
That's
or
exactly.
homes, people are going to stay, and they're going to stay put and be like, man, I can't buy it at this high interest rate. I'm going to wait around.
Nobody's
Guess
buying
what?
homes.
I gotta
Yeah.
pay.
Nobody's
They
buying
can't live
houses.
under the bridge. They gotta they gotta have a
And
place
that
to live.
even puts more pressure on the housing market, right?
Right. And
Class
now they go
A,
find a nice place
they
to
gotta go
rent.
rent somewhere.
Yeah,
That just
that's
adds to the thesis behind multifamily. I mean, now you're talking about that. When it comes down to recessions, we're already starting to see people are reducing their retail shopping.
mm-hmm.
People are
Yep.
starting to, right? We're seeing decreased spending. And we saw even during COVID, people just stopped spending money on everything, but they kept paying rent, right?
Yeah.
People still need a place to live regardless, and they keep paying rent even while they're reducing expenses in other parts of their life, right? So that's why the thesis behind multifamily remains so strong. And the fundamentals haven't changed at all. The demand for
Absolutely.
affordable housing is in crisis mode in America and is in fact considered an existential threat to the fabric of our nation. Right now, new construction has halted. In recession, there's no more new initiated projects going on. Projects that are started may finish, but you're not going to see new initiation of construction. And that construction, which was starting to happen because we're trying to build some more housing because we don't have enough places for people to live in this country. Now that's stopped, right? So in the time like this, we should be looking for investments that are fundamentally sound, but temporarily underpriced. Just like Warren Buffett does when he's buying these businesses in down markets, right? We need to look for opportunities to buy undervalued assets that meet like two requirements, right? Number one, they have to perform well in down markets. And to do that, you have to look at risk-adjusted returns. You don't just look at the returns, right? Oh, look at the ROI. I hear people talk like, look at the ROI on that deal. And, you got to look at it on a risk-adjusted basis, right? So what does that mean? One second here, Tom. Can you see me?
Yeah.
Still, or? Oh,
Yeah. So, guys, if you have any questions, this is a great time to put it in the comments. And I see somebody's asking a question. Good evening, guys. What are your thoughts on the upcoming recession, job losses, current tenants? Yeah, absolutely. People are going to lose jobs. It's going to put some pressure on the rents for sure. I mean, it's not all fine. Everything is not like, cherry on the top kind of situation. There is going to be some pressure. Some people have to be evicted. But the bottom line is, since people are not unable to buy homes, because the prices have gone up, interest rates have gone up, they need a place to live. They need a nice place to live. They are going to go and rent at these communities, multifamily communities, which is going to keep the rents rising or at least at the same level. And guess what? The money is worth less now. If you had $1,000 a year ago, that $1,000 is less 7% because 7% is inflation. So it's worth 900 and whatever, 997, right? No. So it's $930. Okay. So that means even if we don't raise the rents, if the property is cash flowing, we're good to go. We just have to maintain it. And that's why multifamily always survives a recession as opposed to other forms of real estate like short-term rentals. There may be great pressure on short-term rentals. Guess what? Because people can't take that many vacations, there may be not that much
There's some
demand.
stress in that short-term rental. I mean, I see that as, I see some risk there,
So
and you got to look at risk-adjusted returns. That's exactly what we're talking about. This question here from the Don: what are your thoughts on the upcoming recession?
yeah, I just touched on
and
that
job loss
actually.
for current tenants. Yeah, that was the question you were asking, right? So the any other questions here in Facebook? Do we have questions? Anything or no? Nothing really, right? Okay, good. All right. So look,
Yeah,
now when we're talking about what we should, okay, so that question about the jobs, I mean, this recession is also different from many other recessions in that we don't have a huge we don't have people lined up looking for jobs, right?
yeah,
The labor is still a scarcity. We have a reduced
yeah.
amount of jobs going, but it's still it's a different recession in that, it's not like in the 30s where you see these long lines of people waiting for jobs. I mean, that's just not the case. There's still
Right.
2 jobs for every person, basically, so, so now in terms of buying, we're going back to buying undervalued assets, right? And requirements. So the investment, it has to perform well, right? You have to look at like we said, risk-adjusted returns. Somebody says, oh, it has 20% IRR, but it's a crypto mining farm. I mean, that's not the same thing as if you're investing in something that's lower risk, right? So when you look at the level of return, you have to look at it on a risk-adjusted basis.
Yeah.
Right? Especially in times like this, especially in times of down markets, in times of incredible economic uncertainty.
That's the beauty. Go ahead.
Yeah. The next thing is invest in real assets.
Right.
Okay. Is cryptocurrency a real asset? No. Can anyone explain to me what drives the value to go up? What makes a value go down? How does it exactly work? And I've yet to find even experts that I talk to that has been able to explain it to me succinctly, right? It's pure speculation. Now,
that's what it is.
it's speculation. That's it. Now, what about, let's say, gold? Gold is a real asset. And actually, gold is pretty good because in 1918, an ounce of gold bought a good suit. Today, an ounce of gold is worth $1,800, and it can still buy a very nice suit, right? So it's a good hedge against inflation. It's in finite supply, and in an environment where cash is losing 10% a year to inflation, gold might not be a bad idea.
Yeah.
But there's no cash flows.
Right.
There's no tax advantages. So that's when we add real estate to the mix, right? In terms of risk-adjusted basis, multifamily real estate has performed better than any other investment out there since the beginning of time. It sounds outlandish. It's not. It's true. It performed better, and there's a study. It performed better than than any other asset class. Out of all asset classes in the 1980s recession, performed better during the 90s dot-com bubble, performed the best during 2008, during the great financial recession, where everybody's foreclosed, a short sale, everybody would lost their homes and they rushed to go live in multifamily real estate.
That's another thing, right? So
There's
not only that, in 2008, the multifamily units, if there was the number of bankruptcies when people were foreclosed on homes and all that, so many people ask, how did multifamily perform, right? The number of foreclosures or bankruptcies on multifamily assets that was over 32 units.
Next to nothing.
Next to nothing. But people who own 4 units, 6 units, 2 units, duplexes, they got hit hard. They had to file for bankruptcy, and I even know a few people who did that. So it's very safe. That's the thing. You need to look for something safe.
I mean, look if the historical precedent shows it. When you look at the recessions, All the recessions, it performed well during the recession, even during the quick recession of COVID, 2020. People still continued to pay their rents. Multifamily real estate continues to perform with excellent returns after taking the risk into account. In terms of tax advantages, multifamily real estate has probably the best tax advantages out of all investments and all real estate.
Right.
Because even the straight line depreciation is over 27 and a half years versus office or industrial buildings, which is over a 39 in a year time schedule. So look in times like this, look for investments that are real assets, right? That cash flow, they hedge against inflation, they're recession resilient, and has tax advantages. And that is how we survive the winter, ladies and gentlemen, right?
Yep.
That's how we are going to make it through it. We're going to still produce cash flows, and we're still going to build wealth, even during the investor winter. So with that, I mean, that's kind of what we have for today. I want to say now, a lot of guys have been reaching out to, this is some housekeeping stuff. A lot of guys reach out to us directly and you want to invest in and asking about investments. So, we don't like to do investments with anybody that we don't know, right? And we do have some excellent opportunities coming. So before you do that, you must have a call with one of us. I'm going to put a link up so you can book a call directly. And if you, wait, hold on a second. I don't know if this will
Where's
work
that
or not.
link? It
Let's
didn't
see.
come up.
Let's see if it works. I don't even, that's
Yeah,
it.
there you go.
Check it and see. Can you check, Tom, just check that website and see. I don't know if that's it or not. But regardless, okay, so you know what? I'm going to put that up. So you have to have that call with us first so we can learn a little bit more about you, right? We can see it didn't work, right? I can just find a way to do it. Hold on. Shoot.
Or for now, why don't you guys just reach out to us by DM?
Yeah, you can reach us directly. Yeah. Hold on. I'll just put up if you go on the website, you can find where to book a call or reach out to us directly on Facebook,
LinkedIn. I mean, wherever.
Yeah, and then after that, we find out a little bit more about you. You can learn a little bit more about us. We can see if we're a mutually good fit. And after that, we can give you access to our deals, which will come in for a webinar. And we do have some excellent assets with all of these
working on
things
some amazing recession-proof assets.
Yeah,
that cash flows and will. Yeah, it's coming up. Yeah, that's a great question. Somebody's got a couple questions.
This is Captain Ryan Humes. This is my nephew, Captain Ryan Humes. He just became captain at Delta Airlines. So a lot of the big Delta jets, he came up from regional. Now he's still at late 20s. I think he's still 20s, right? Right. So anyway, so his question is, what effect has this recession had on finding multifamily deals? Yeah, it's made it much more difficult. Definitely. The sellers have disappeared, but because sellers, you got to remember, Ryan, sellers are like, hey, look, people were offering me $16 million for my property in the beginning of 2022. Now they're only offering me 12.
Yeah.
Like, right. Okay, I don't want, what? I'm not selling now. I can sit on cash flow. I'm going to wait till the market turns around. And guys that have no reason to sell, they're not selling. And as a result, nobody's selling. And like we talked about, banks aren't lending. They require more equity. It makes it more difficult for paperwork to make it a deal paper, right? And then on top of that, we don't have any less buyers out there buying. And so, yeah, it is more difficult. But guess what? When the deals do come, and like we were talking about on this live, they will. There's 3 Ds that will cause deals to happen: death, divorce, and dissolution. Right? Those 3 things.
Yeah.
Will cause, and dissolution, I mean that weak operators that can't hang anymore because the deal is beyond them and they got to get out.
Yeah.
That's when they dissolve partnerships. Right? So that's when we get involved. Death and divorce is obvious. And so those 3 Ds. And then when there's nobody out there to buy, but there are a few savvy investors that are out there that can recognize good deals and they have a great operations, great operator that can bang it out in that local market, that's when you can make fortunes are made, ladies and gentlemen. Fortunes are made in down markets. So yes, it's more difficult, but it's well worth it. So the point is, keep the grind going. In the next few months, yeah, that's definitely in the next few months.
Absolutely.
There's another question.
There's another question, Jonny. Can you answer this? How do you risk adjust return?
How do you risk adjust return? Where I don't even see that. Where's that? That's on Facebook.
It's on Facebook. Yeah.
Yeah, I mean, so when we say risk adjusted returns, we mean how well is the risk mitigated in order to get these returns, right? So when you compare when you're comparing two investments and you're just looking at the returns, you're like, well, this investment here in a short-term rental gives me 22% IRR. And then there's this multifamily deal that says 16% IRR. And if you were to just look at those two deals and say, I'm only going to use IRR as my basis to make investment, then you're not adjusting for risk there, right? And that is a poor way, and that's a novice way. A lot of people look at investments, they just look at the shiny IRR on this thing. And 2012 to 2022, yes, you could do that. You could invest in everything. Everything was going up. But what I'm saying is nowadays, the landscape of investing is different. You have to look more at capital preservation, focus on capital preservation more so than ever before, because the number one rule of investing is don't lose money. Number two is to make money. But people forget about number one, and they could forget about number one because everything was going up. But now is more important than ever to not forget rule number one, which is capital preservation. So what is the less chance for you to lose money? I'm not saying short-term rentals isn't a great play, and I strongly considered a short-term rentals investment. And this was my reasons for not going with a short-term rental, even though the returns are potentially higher. I see great headwinds in the future. I see an economy that's slowing down. I see less people. I see tech companies laying off jobs by the thousands. I see lots of jobs being lost. So now, are those people going to be taking that weekend trip to Nantucket, to Branson, Missouri, to Olympia, Washington? I mean, are people going to be taking those trips anymore? And if they because people don't have disposable income and things are rough, and we potentially go into a deepening recession that maybe even potentials into a depression, I don't see short-term rentals having a great future potentially. Maybe the market comes back and maybe short-term rentals perform great. I don't know. But I do know that multifamily will perform because there's a historical precedent. It's been doing it. And we know that the reasons and the thesis behind it remain very strong. So that causes me to say, well, now when we compare this deal and we start to compare it with the element of risk, also weighing risk also with these returns, then we start to see that multifamily, we get the highest level of returns on a risk-adjusted basis, on a risk-mitigated basis. There's no investment that will give you a higher return than multifamily. So that's what I mean by risk mitigation. And I think it's more important now than ever to be wary and to be prudent and to question everything when you're investing.
Yeah, especially so now, the other thing that also is, Jonny, very good things you touched on. The excellent points about that, right? One more thing I would want you, if you want to be hedging against all this and be careful, right? You always want to go with seasoned operators, people who have done deals, and who know what they're doing, because always as your seasoned operator can always outperform, even if the market went south a little bit, they are able to bring it back up. It's the analogy of betting on the jockey, not the horse. So always look for great operators. So I think that's all the questions we have then for today.
Yep, that's it for today. So I hope you guys got a lot of value. Please feel to reach out to us, ask questions. We're help. We're here to learn also. If there's anything
a question.
Ask questions in the post
and DM us
wherever it's. And to book a call, definitely. If we, like I said, we have opportunities coming up, so just reach out. Like I said, you can book a call directly on my website. I'm just trying to figure out exactly. Hold on.
Just put that link on the website. like, so when you go to his website, you can just click that link and book the call.
Exactly. Hold on. I'll tell you right now. Oh, here we are. This is what it is. Call. Okay, here's the link. Dr. Brian Craven. Wait, let me get my guy up here. Thank you, Dr. Brian Craven, for joining us, man. You're the man. So that's the link right there. Now that link should work. You can book a call directly. And yeah, we'd love to hear from you. Reach out to us. And we'd love to for you to join us on this. All right, guys. Hope that was a ton
Every
of value.
Tuesday.
See you next Tuesday.
See you
Every
guys.
Tuesday. We'll